Hey folks, Andrew Packer here. Welcome to Trading Tips. In the past videos of this series, we've looked at the basics of options. We looked at how specifically buying just a call option would play out, followed by what happens when you just buy a put option. And we looked at how to use options with your stock portfolio with two great strategies: selling put options to potentially enter into a trade and make money along the way, or selling call options to potentially exit a stock trade while also making extra income along the way. Now, for most investors, these strategies are really all you need to make profits big and small time and again in the market. However, there's a lot more that you can do with options. All of our videos so far have covered a single options trades, but you can also pair trades as well. Now, when you pair trade in investing, you're looking for an outcome in a way that reduces your risk in case you're wrong. So say you liked oil as an investment right now, you might consider buying shares of an oil company. But you might also pair the trade by buying shares of an airline. That's because airline companies have high fuel costs, and a sudden rise in oil prices tend to cause their shares to decline. Now, if oil didn't rise as much, the airline company would, all things considered, perform well. And if oil prices were to fall, you'd make money on your airline stock because its shares would very likely rally. But the oil company portion of your pair trade would likely fall. So, done right, it's a bit like a seesaw. If one side goes up, the other's apt to go down. Now, that's a classic example of how a hedge fund might make a pair trade in the stock market while being long on two companies. But it's far from perfect because there are other events at play than just these two companies. In a raving bull market, both companies might go up as well, doubly rewarding someone for being long either. In a bear market, both companies might go down, doubling down on losing positions. But it can be used with options as well. And even more interestingly, you don't need to think in terms of companies that zig and zag against each other. Instead, you can use options to set up a pair trade within the same stock. So here's how, using an example of a bull call spread. Now, that's where you think the underlying stock is likely to go up moderately in the near term. So for instance, I expect shares of most technology companies to rally going into the end of the year. Now, maybe it won't be a big rally, but there should at least be a modest recovery from here. So let's use Advanced Micro Devices, ticker AMD, as an example. This is a great company that's down over a third from its recent high, but is still up year to date. They've been killing it in terms of earnings and profitability, so this is a company that should rally in the coming months. Although in this market for tech stocks, it's a risky proposition. That's why it looks attractive to use what's called a bull call spread. To set up such a spread, we will buy one in the money call, and then we'll also sell an out of the money call. So by selling the out of the money call, we're going to get some cash up front, akin to selling a covered call, except in this case without owning the underlying shares first. But that's okay. We don't have a huge risk because we bought the in the money call, which we can exercise when the option expires as needed. So by selling one call, we offset the cost of buying the other. Now, shares of AMD are just under $21 as I make this video. So using the widely traded April 2019 strike date, I would consider buying the April 20 call for about $380 right now. And I'd sell the April 25 for around $2. So we spend $380 per contract on the April call, but we can get a $200 credit for the April 25 that we sell, so that we can get into this particular bull call spread for just $180 for the pair. Now, I've already drawn here on the board what this bull call spread looks like. We can see that we'll lose the maximum $180 that we have if shares are under the lower strike price of $20 come expiration in April. And we can see that our profits will be capped if our shares rise above $25. That's because both options will rise dollar for dollar after hitting $25 per share. And any extra profit that we have on the $20 calls that we bought will be offset by the dollar for dollar loss on the $25 calls that we sold. But on the flip side, here's what we gain. If shares end up around $24.99 at expiration in April, the $25 call will expire worthless and we'll keep the entire $180 premium we sold on those $25 calls. And our $20 calls will be in the money by $4.99. Subtracting out the $380, we still get $1.19 in profits there. Add that $1.19 to the $180 and we get a profit of up to $299 maximum for each bull call spread that we made on this stock. So considering the underlying shares are just under 21, we're still looking at about a 10% profit between now and April based on what the price of shares are. And again, if shares end up moving even higher than the $25 call we sold, the extra profits on the $20 call option we bought will cover that loss. So, as we can see under this strategy, we're capping our gains, but we're also capping our losses because there's a limit to what we can lose. The cost of the initial option we bought less the cost of the initial option we sold. So ultimately, we could potentially make up to $500 on this trade, but the most we can lose on it is $180. Where we make the money between this spread depends on where AMD shares go from here. That's why this strategy works for a company where you expect a modest rally, but not necessarily a huge one. If you expected a huge rally, you could just buy a call option and call it a day, much like we did in our first video outlining an opportunity in the pot company Tilray. But what if you expect a decline? For that, we can look at a bear call spread. It also uses call options, but instead, we flip which option is being bought and which is sold. Now for this example, I'll use graphics processing company NVIDIA, ticker NVDA, as an example. While I like what the company is doing in the tech space, they recently reported lower guidance going forward, so I expect shares to continue declining, albeit modestly over the next few months. Now, to set up a bear call spread on NVIDIA shares, I would buy an out-of-the-money call, or a call option that's well above the current share price of the company, and I would sell an in-the-money call. The share price of the company is around 165 as we record, so in this example, I might buy a March 2019 200 call for about $710 or $710 per contract. Then I'd sell a March 2019 150 call for about $28 or $2,800 per contract. So all in, we'd end up with a credit in our account as we get $2,800 for selling the call, less the $710 we pay out, leaving us with an initial balance of $2,090. It'll be up here on the chart. Let's fast forward to March. Now, if shares are under $150 as we expect, both call options have expired worthless. We keep all the premium that we sold. So in a way, it's a lot like selling puts on a stock in that regard. Now, if shares are between $150 and $200, we'll have some premium on the 150 call we sold. Our $200 call, however, would expire at zero, so we could lose some money here. And if shares trade at $199, for instance, our 150 call will be worth $49. Since we sold it at $28, we'd be underwater by $21 or $2,100 per contract. Over $200, the $200 call we bought would move dollar for dollar in our favor, as the $150 call we sold moved dollar for dollar out of favor. So in this trade, we're likewise capped in terms of gains. Now, a bear call spread is a nice way to make a bet on a stock declining. But in most situations, you run the risk of potentially losing more money than you could make. Now in this example, the difference is minimal, but a bull call spread can typically lead to a larger dollar gain than a potential larger dollar loss. But when it comes to investing, it's nearly always going to be easier and less costly to build long positions and betting on something going up than betting on something going down. This covers an option spread technique just using call options. Now, it's just for positions where you expect some movement up or down, but not big moves either way due to the capped profit potential. There are more ways to create option spreads. For instance, you can make a bull and bear spread just using put options instead of call options as well. Or you can have a spread that involves the same stock, but with different strike dates. We'll likely look at a few examples of these kinds of trades down the line, but generally call spreads are the easiest to use because call options tend to have more market volume on a typical stock. And it's also easiest to use the same strike dates because the further out of an option chain goes, typically the less tradable options there are. There are of course a lot of factors at play when making these determinations. But having looked at them, I'd say they're a good tool once you get to a point in your portfolio where you're looking for steadier profits just using options. So think about it this way, with the AMD example, if you're bullish on shares and they've been as high as $30 in the past year, you can make a far better percentage return buying a $30 call a ways out. And if shares end up going back to that old high, you could double or triple your returns on a modestly priced option today. However, if that doesn't happen, you'll lose all the money you put into the trade. Now, for smaller investors, this more volatile trade can work out well, particularly if you're still at a point where you can add more capital to your account if a trade goes wrong, as they periodically do. With an option spread, you're limiting your upside in either case, but the triple-digit returns are also out. But again, you're cutting your potential losses, the total amount of money that you put into the trade, by selling an option as well as buying. So it's a tough trade-off. I personally don't use spreads as often as simply making a directional bet, such as buying a call or put in a single trade. But it's a strategy that I would be willing to use under the right conditions. That'll wrap things up for this week. Thanks for joining us at Trading Tips. I'm Andrew Packer, wishing you good trading and good financial health.